My name is Christian Hallman, the Communications Director for PSPRS. This is probably about my third or fourth annual event. One of the things I have to do for PSPRS is explain the general investment strategies and investment asset classes and performance to our stakeholders. This can be a pretty big challenge because our stakeholders vary from retirees to active members, to employers, to finance directors, to policymakers like city councilmen and state legislators. So it's always a challenge figuring out exactly how to talk about things, what detail to put in, at the same time making things understandable. So last year we did a presentation where we had our Chief Investment Officer, Mark Steve, talk about the great deal of thought that goes into the investment decision-making process at PSPRS. The year before, we did more of a kind of a dry run-through of PSPRS investment performance and strategies. Our exit polling came back just okay for each one of those presentations. So this year, we wanted to do something new, and more importantly, Mark Steve was out of town. So this is, it's my great pleasure to introduce Harry Papp. Harry Papp is a very experienced and respected Arizona investor. I'd like to point out we also have Dean Shiner, one of our trustees in attendance, who's also got a long career of investing. Harry, I guess, tell me about your upbringing a little bit.
So I grew up, my father was an investment advisor. I grew up in Chicago, and dinner conversation, not surprisingly, had to do with corporate earnings and things like that. So I got an early start on that. But, I've always been interested in business and finance, economics, and I got a lot of that at an early age.
So, did you have any brothers, sisters? What's your family life look like?
I have one sister, and she's actually a partner of the firm. She's a chartered financial analyst. Dean is a chartered financial analyst, and so am I. And if you called Goldman Sachs and said, I'd like information about Boeing, the analyst on Boeing for Goldman Sachs, there's almost a certainty she would be a chartered financial analyst. That's the designation you need to be a research analyst on Wall Street. So, yeah, Tori's been with the firm for 20-some years. She lives near Seattle, so she's not. She's active on strategic things, but not many day-to-day activities.
Gotcha. Now, aside from, I guess, maybe reviewing balance sheets or anything like that, did you have any sort of hobbies going on?
I enjoyed playing ice hockey when I was a little younger. My wife will not let me play anymore. That's been a very sad circumstance, but just the usual things for kids. But I'd say normal type of hobbies and things like that.
Gotcha. Now, was it generally expected that you would follow your dad in getting into investing?
It wasn't all that clear. I was a chemistry and economics major undergraduate, and I ended up with also a master's degree in geochemistry. I wanted to try and see if I wanted to pursue science as a career, and spending a year and a half at University of Chicago with world-class scientists, it was fun, but wasn't what I wanted to do the rest of my life. So I don't think it was a huge shock for my folks that we got involved with the firm as well.
Gotcha. So since then, I guess, well, let me back up. When was your first investment? What did you invest in?
Oh my goodness, this would have been. My dad would let me buy penny stocks, not penny stocks like troublesome stocks these days, but he would essentially sell me artificial shares of a stock with Christmas present money, things like that. So I was probably 8 or 9 when I was investing in one thing or another.
You spent your Christmas money on stocks.
Yeah, or money earned working in the summer, that kind of thing. So yeah, it's fun to watch them go up.
Yes, it is, especially when you get in when you're 8 years old.
And it's also, you know, it sounds funny, but and we do this, a lot of universities do this where students will pick stocks and it's really interesting when you just do it on paper and there's no money involved. It's never like it really is when there's money involved. And you look at things and go, oh yeah, I would have let that ride, I would let that go up. And if you had real money in it, you wouldn't do that. So it really does take a discipline, whether it's $8 or $8 million. You need something that really catches your attention and taking it seriously. Otherwise, it's easy to say, oh yeah, I would have made all that money on paper. And you would have, except you wouldn't have done it. And once you had success, if there was an awful lot of money in a very dangerous asset, 99% of the people would say, well, that's great, but I'm taking 80% of my money off the table there. And that's a proven thing to do in most cases.
So you've been, I guess, investing other people's money professionally for about 40 years.
Yes.
What are some of the biggest lessons that you've learned?
You have to be patient. You have to know what you're doing. For us, it's all about fundamentals. We care about the fundamentals of the company. So we will own a company. Our largest holding, I think, currently is Apple. And that's easy to say today because Apple's on top of the world. It's the world's second largest company. But and it's interesting. A lot of people talk about smaller companies that nobody's ever heard of. Anybody heard of Apple? It's the world's second largest company. For a while, it was the world's largest company. And everybody knows about it. You know what their products are. But yet, a year ago, the stock was half where it is today. Boy, was this stock mispriced. And that's because the last iPhone had been sold in China. And we were going to have a recession in 2019. Who thinks we had a recession in 2019? Who thinks the last iPhone has been sold? The article in the paper this morning says Apple has contacted Taiwan Semiconductor that manufactures the chips that go in the phones, and they've ordered more because they're selling out. Anybody think that's a good thing? Maybe that's why the stock's at a new all-time high. So for me, it's about fundamentals, it's about doing your homework, and it's about patience. And if you are confident that you are right on the fundamentals, that should give you a lot of confidence to stay with an investment, even if it's not working particularly well in the short term. When Apple went down, when the last iPhone had been sold, what should you have done? You should have bought some more. It takes a certain amount of courage. In 2009, the market hit its low on March 9th, 2009. If you owned General Motors at the time, should you have stayed with it and watched it come back? You couldn't. It went bankrupt. If you had anything you had in it was gone. If you owned Chrysler, it went bankrupt. What should you have done that day? Ford didn't go bankrupt. And if you had a certain allocation to auto stocks, a great idea, and Ford's not doing so well right now, but a great idea since you couldn't retain your General Motors position or your Chrysler position, you should have taken some fresh cash and bought some Ford. If you did that, it would have done really well. So for us, it's about patience. It's about doing your homework and making sure you're knowledgeable about the fundamentals. In my firm, and I'm not here to sell our firm, but we have 8 chartered financial analysts. We have 3 people that spend full time doing nothing but analyzing companies. And there are probably 4,000 companies you could buy just in the United States. Well, there's 3,500 companies we're never going to buy. So we don't really have to look at those. There's 500 that we might buy. Or there's 300 that we might buy. There's great companies out there. Most of them, the cat's out of the bag. And people have figured out that the company is a really great company. But every once in a while, we get a chance. And every once in a while, something happens. We had a discussion in our shop a week ago about this company that's got a little problem. It's called Boeing. Okay? If they were flying MAX 8s and they were taking off from Sky Harbor Airport today, who who would fly out on a MAX 8 this afternoon from Sky Harbor? It's going to take some work. They got to get certified. They got to get back in the air. They're going to have to win public approval. I'm going to want to see the head of the FAA hop on a plane and fly around. I want to see him go from New York to Miami to Chicago to San Francisco. And I don't want to just see the head of the FAA on the flight. I want to see his kids. I want to see his grandkids. I want to see the grandkids of the CEO of United Airlines on that flight. I want to see the kids and grandkids of the CEO of Boeing on those flights. I want to see those folks. And when they're happy to fly around, then maybe I'll get on a MAX 8. Probably will happen. You know the company. It's a really fine company, but it's got a really serious problem. And how long is that going to last? I can't tell. And if I can't tell, I'm probably not going to play. I want something where I can analyze pretty effectively what the probabilities are and make a really informed judgment and have a large margin of safety.
Wow. What is it like to work for you? What kind of boss are you?
We try to be collaborative. We have 3 folks that work in the research department. I have to be a little careful. The head of we're a little incestuous. My dad used to say, if things are going well, you can't do better than nepotism. If things are going badly, you couldn't do any worse than nepotism. My wife is our research director. I take care of the private client accounts and worry about income taxes for clients. It's one of the things we don't have to worry about here at PSPRS. But she heads up the research department, so she's really smart, and they do a great job for us. So it's collaborative. You also need a team. You can't do it all yourself. I can't possibly take care of all the accounts, and I need a team of people that we're all compatible and that we're all confident with. And that's what we have. We've built that over time, and we've got a great team. And we have probably 450 accounts at the firm, and you really couldn't tell which manager was managing the account based on looking at what's in the portfolio. So that's important for us, because if somebody hires my firm, they're not hiring me, they're not hiring another individual, they're hiring the firm, and they deserve to get what the firm can produce.
And I guess most people, most lay people obviously will look to employing a financial manager so they don't have to know that, so they don't have to worry about that. When you're dealing with people's money, obviously I'm sure that people can be quite emotional and reactive. What are some of the lessons that you try to impart on people about investments?
The most important part of our business is, in terms of building a portfolio, is making sure we have the right mixture of risk for the owner of that asset. And if we put too much, if we make a mistake, if we put too much risk in your account and the market goes up like it did last year, the outcome is you're going to make too much money. Now, who's going to be upset with that? Nobody. Well, what if we have the other error? What if we don't put enough risk in your portfolio? Well, shame on us. But if we put too much risk in your portfolio and the market goes up, you'll be fine with that. What if we put too much risk in your portfolio and the market, as it inevitably does sometimes, goes down? You're going to look at the account and you're going to say, oh my God, I lost more money than I thought I was going to. I'm not sure I'm prepared to take that level of risk. I have too much risk. And now what should I do? Well, I have to fix it. I have to remedy this. If you're taking too much risk, how do you remedy it? You sell some of the risk assets. And when are you going to sell them? After they've gone down. Okay? I pretty well assure you, if you sell risky assets after they've gone down, you're going to get a bad total return. So I have to gauge your own situation, your assets, your liabilities, your income needs, your family needs, how you deal with risk, how you feel about uncertainty, what's your comfort factor. And I have to model all of those. I have to try to understand that and come up with the right mixture of stocks and bonds so that we're going to get you the highest total return you can over the long term without taking crazy risks. And then we spend a lot of time on that. And we do that at PSPRS as well, because, as you said, this is not our money. We have a fiduciary responsibility. That means we are required, legally required, to put our members and our employers' perspective, we're supposed to put their perspective ahead of any of our own interests. And that goes as well for my firm. We are fiduciaries. We are required to put the client's interests ahead of our own personal interests.
Now, when you became a trustee on the PSPRS board and you took a good look at the asset class and began, I guess, understanding a little bit about the history of the investments, the nature of being a multi-employer plan, what were your thoughts?
My first thought was that our portfolio did not take enough risk. We did not have enough assets allocated to risk assets. And that's a shame. And that's lost opportunity. And not to be critical of what went on in the past, there was a reason for that. It was called the PBI, the permanent benefit increase. And there was a crazy situation that if PSPRS ever earned more than 9% in a year, let's say they earned 15%, that's 6% of excess earnings. We got to keep 3% of that 6% to pay pensions. The other 3% went to beneficiaries, which is great for permanent increases, for increases in their pension, even though we were badly underfunded. What happens if the market goes down? We keep 100% of the loss. So if you go to Las Vegas and every time you play roulette, if you win, you only get to keep half of the winnings. But if you lose, you get to keep all of the loss. Okay? You know the people that built those nice hotels in Las Vegas, they're probably not fun. They're not probably losing money in the roulette business. They're making money in the roulette business. But boy, if you lost half of your upside but kept all your downside, you couldn't possibly win. And as a result, so if you play roulette and if you win, you only get half the winnings, but if you lose, you get 100% of the loss. What's the best strategy? Don't play. Don't play, because you're going to lose rapidly. And so this portfolio was heavily de-risked. Now, historically, things are a little murky exactly who did what when, and it really doesn't matter. It's water over the dam. But this plan did very well in the late 90s when it had a large allocation to technology stocks. I will tell you, one of our largest holdings is Microsoft. And if you bought Microsoft at the high in 1999, you'd have paid $60 a share for it. Does anybody think Microsoft is a successful company? I do. I bet if we called Bill Gates and said, "What do you think? You dropped out of college, but you probably did okay. You sum up your life, you probably did okay." If you bought it in 1999 and stayed with it, you would have had to wait until 2016 to get back to even. Boy, would that have been a terrible investment. Just terrible. But in any event, I've lost my train of thought on that.
Well, maybe you'd like to.
So back to the
portfolio allocation.
Right. So, well, let's go on to the next one.
Sure. Would you like to walk
Sure.
our audience here today through a bit of the PSPRS portfolio allocation underlying strategies and what each asset class is actually designed to do?
Sure. So first of all, let me explain. We've got a pie chart here. Obviously, it's 100%. And we'll start on the top right-hand corner, almost the blue wedge, which is maybe 20% of the portfolio. It says comments, it's U.S. public equities. These are large U.S. companies, and CA means we own them for capital appreciation. Do we want to get the dividend? Yes, we want to get the dividend. The dividend, we hope over a very long time that these assets will produce about 10% for us. We hope about 2% of that will come from dividends, and we hope 8% will come from capital appreciation. Historically, that's what's happened. The black pie chart, black chunk is international equities. They haven't done very well the last 10 or 15 years. They haven't done near as well as the domestic companies have done. But again, we own them for capital appreciation. There have been great debates going on the last 15 years about should you invest your money in European stocks or Japanese stocks or American stocks. And if you talk to New England Pension Consultants, our main consultant, they have about $1 trillion under advisement at this point. They would tell you that European and Japanese stocks are less expensive than American stocks. And they're right. But if you talk to my wife, she would say, yeah, maybe you get what you pay for, because there are real problems in Europe and Japan. There are real problems here too, but they're different and maybe they're not as severe. So that's the second chunk. After that is private equity buyouts and venture capital. The orange bar is private equity real estate. The purple wedge is real assets. Those are things like gold or oil and gas. Those haven't done very well the last 10 years because there hasn't been very much inflation. Those are the kind of assets that do very well during periods of significant inflation. And then we have CA, other private holdings. It's a small slice. These are some legacy holdings there. So about 65% of the portfolio is allocated towards growth type items where we're getting some dividends, but what we're looking for is 70, 80% of the total return coming to us in growth. And historically, that's worked really well. A lot of people in this industry talk about a 70-30 mix, and that's a naive mix where you just put 70% of your money in the Standard & Poor's 500 and 30% of your money in short-term treasuries. And historically, that wouldn't have done too badly. Also historically, though, when you just have that mixture, you're going to have more volatility than if you have all these other asset classes. So we put these other asset classes in here to provide diversification for us. Not all of our eggs are in one basket. And so, many of these assets are not highly correlated. You can imagine that if Coca-Cola is doing really well, there's this other firm that's probably doing really well too, because Coke and Pepsi are highly correlated. But Boeing and Pepsi are not very highly correlated. They're very different businesses. And so these other slices tend to be diversifiers, and we have them there. We're trying to make a decent total return. We're trying to hold down risk, and we're trying to hold down volatility. If we have wild spikes where the market's up a lot one year and down the next year, we have some other mechanisms to deal with that, but the effect that it can have is to change contribution rates a lot over time. Who thinks it's a great idea to have contribution rates spiking up and going down, spiking up? Who thinks that's a great idea? Nobody. We're trying to have a very good total return, but we're trying to minimize the volatility and dampen the fluctuations. And diversification will help us a lot with that. The next items are core bonds. These are just IOUs from the United States government or from high-quality borrowers. Companies like Johnson & Johnson and Microsoft, which are AAA credits. The next one, private lending. These are loans, and we do a lot of this. PSPRS is one of the leaders in the country on private credit, where we're making loans to businesses. We're not doing, we have advisors that do that for us, but we've got money allocated there, and we're making loans to private businesses. You better be right if you're doing that. You better be doing your homework. You better know they're going to pay you back. But you can get a pretty good return there. And this is something opportunistic because after the Great Recession in 2008, 2009, the government changed the rules for banks. And many of these, almost all of these loans, are loans that 20 years ago would have been made by the bank. For a variety of reasons, the bank can't make that anymore. So there's an opportunity to lend into that and get decent returns, 7 or 8%, maybe 9% in interest, where in a treasury today we get 1.5%. When we're trying to invest a portfolio for a 7.3% return, we better not put too much in some component that pays 1.5 or 2%, because for every 2% I got to earn 17% to neutralize that. Yes.
So what type of entities would be the ones requiring this type of funding?
Typical businesses. I'm blanking on a couple of examples. These are companies that are typically smaller companies. They might be real estate investors. They might be companies that are buying out another company. And they might have leverage ratios of 3 or 4 times, where they would have 60 or 70% debt, something like that, but yet a pretty stable project where there's significant cash flow. Now, if stuff goes wrong with those, it's not just like clipping a coupon. Things are going to go wrong, and they're heavily impacted by the business cycle. During good times, they do fine. During bad times, some of them go out of business. If they go out of business, our advisors have got to be prepared to say, okay, I lend you that money, you're going out of business here, I got to come in and get as many assets as I can, I've got to sell those distressed assets, I've got to reposition them, and I've got to collect everything I can. And those are not easy. It is not easy to do that. So that's why we have advisors who have a good track record for a long time in diverse industries doing this. We're also careful not to concentrate just in one industry. 4 or 5 years ago, there was a relatively high concentration in oil and gas companies. And folks that did that, just lent into that market, didn't do very well. So we're pretty well diversified there.
Harry, all in all, what's your opinion on the recent to mid-recent historical performance of PSPRS, given their investment strategy?
It's been good. I mean, we've done really well with private equity, private debt. I look at Bloomberg every morning and get current information about what's going on today. There have been a number of Bloomberg pieces. One about ASRS investing a greater percentage of their money in private debt. Well, welcome aboard. That's where we're at. We've been one of the leaders in that. That's been going really well for us. Private equity's been going really well for us. Real estate's been going really well for us, with one little exception. We do have some legacy real estate that it was from a different time. I've lost some money. Who's lost money in Arizona real estate over their lifetime? Welcome aboard. It's going to happen. Things are cyclical. You can't necessarily predict things with certainty. We still have some legacy real estate, and we have recently changed our strategy and how we're dealing with that and how we're managing those assets. I feel good about that, but our legacy real estate portfolio has been a real drag on performance the last 5 or 6 years. Other real estate, where we've hired very good managers to go out and invest in a broad array of real estate, they've done very well for us. We saw a group, Miller Global. You and I had dinner with them last week. These are smart people. They've made an awful lot of money. and they've done a really good job for us. So I think we're doing well with the current assets. We're managing them well. I will tell you that historically, we hired people like me to do what's called active management, where we pick out and say, yes, we like Johnson & Johnson, no, we don't want Boeing. Yes, we want Home Depot, no, we don't want Amazon. Historically, we've not done very well as a system with that. So what do you do if you're not good at it? Stop playing. So now we're invested almost entirely in index funds, where if there are 500 stocks in the S&P 500, we just buy all 500 of them in the right proportion. And the benefit of that is that the fees are very low, turnover is very low, and how are you going to do? About as well as the index. And if historically you can't, you trail the index and you pay a lot of fees, note to file, stop doing that. And that's what we've done. So we're pretty passive in the equities, in the marketable equities. We've done very well in private debt. We've done very well in private equity, and we've done very well in real estate. We haven't done very well in legacy real estate.
Harry, I guess to clarify, when we speak about legacy real estate, we're talking about real estate investments that PSPRS participated in the late 90s, early 2000s.
Correct.
Obviously, we've run into about the 2008, 2009 housing market crash, where Arizona in particular is practically ground zero for this crash. Looking back, I mean, when things were good, obviously all the signs were great. I don't know who would have seen the real estate crash all the way back from the late 90s, but was it an understandable bet? And what does our current PSPRS investment team, what's their challenge in handling this investment from previous administrations?
Well, the criticism I'll give previous administrations is, and it's easy to do this, who wants to invest in Michigan? What's the net inward migration in the state of Connecticut? Who wants to retire in Alabama? You'd be out of your mind to invest in places like that. What's been the net inward migration for the last 125 years in Arizona? It's been huge. It's been consistent. How many people in this room came from somewhere else? 90%. That was true 100 years ago. People come to Arizona because they want to, not because they have to. And we have a few that grew up here, but by and large, people come here from somewhere else. And that's been going on steadily for over 100 years. So it's a good bet over a long period of time. I know we've got some fifth generation, and thank God we've got that. But we need some leadership there. But people are still moving here. By and large, over a long period of time, Arizona real estate, I think, is likely to do well. It is very cyclical. What happened in 2008 and 2009, the meltdown of financial institutions, was uniquely bad in Arizona. Did we have some clues? I had some clues. Many of my doctor clients in 2006, I'd ask them, what are you doing this weekend? And they'd say, I'm getting in a car. I'm going to go out to Anthem, or I'm going to go out to Verado, and I'm going to put my name in a hat. And if they pull my name out of the hat, I'll be able to buy a house. And I would tell them, but I've been to your house. You have a perfectly nice house. Why don't you buy another house? And they'd say, oh, it's not an owning house. It's not a moving in house. It's a flipping house. I'm going to sell it to the next guy for 40% next year. And I thought, boy, I wouldn't spend that profit too quickly. But we had something like 40% of all the single-family homes that were sold in Maricopa County for 3 years were sold to people that, honest to God, did not intend to live there. Okay. With the benefit of hindsight, who thinks that's sustainable? That was just crazy. So we did have some crazy valuations. Because we live in what most people think is a good place to invest in real estate, I think some of our predecessors thought they could do it themselves. And they could buy real estate right here in Arizona, and who would know that better than they would? And that didn't work out very well. So we don't do that anymore. We use places like Miller Global, who are diversified, and we've heard about some real estate in San Diego that's not doing so well. They sold some real estate in Portland and made a ton of money on that.
Now it's not doing well.
What's that?
And now it's not doing well for the next person.
Yeah, but they sold, so that's their problem. And but they're building a hotel in Scottsdale. But they're going to be successful with that. So it's diversified. They're professional. Nobody gets sucked into some local situation. So I think we'll do better with that.
Gotcha.
So far we have.
I guess we're getting our shot clock warning here. I'd kind of like to open it up if anyone's got any questions for Harry about Arizona PSPRS investment strategies risk in the back.
One question on the private credit. If we experience a slowdown in the economy in the next year or two, what is the duration or short-term, long-term paybacks on those on the private credit side?
It's anticipated. Most of them have 3 or 4 or 5 year maturity, but the maturity doesn't mean anything. That's what the stated maturity is. If we have a slowdown, some of those companies will have a hard time paying back their money, and it'll take a little longer for that money to come back. So the answer is, let's say 4 or 5 year average maturity, so maybe a 3 year duration. But that duration would extend, and we will have another recession. My bet is I don't think we're going to have it in the very near future, and I bet the next recession won't be nearly as severe for Maricopa County or the state of Arizona as the previous recessions. And I think it'll be a relatively mild recession. Now, our private debt portfolio is nationwide, so and we have some international as well. But I don't think the next recession is going to be anywhere near as severe as 2008, 2009.
Harry, we got another one in the corner over here.
We will have some losses, but I think we'll have pretty good recoveries. Yeah.
Mr. Papp, do you feel that the unrealized gains investment is able to be recovered at any time in the future, given the future economic outlook?
Unrealized gains?
Compared to what PSPRS is, forecasted for actuarials of 7.3%.
Right. So that's a great question. We deal with that all the time. So our assumed rate is 7.3%. Stock market was up 30% last year.
Right.
Real estate prices are high. Bonds yield 1.5%. European bonds yield negative returns. So all of our advisors, if we had New England pension consultants here, and we said, what are your expectations for these various asset classes going forward into future years? And if we said, I'll give you 3 choices: long-term average, above average, or below average. And the only thing you know is that we start at a high level. They all say below average. And they would, New England pension consultants, over the next 3 or 5 or 7 years, they'd probably suggest a rate more like 6% as opposed to 7.3. So I work with Wilshire Associates with Blue Cross. We have $1.8 billion. Their capital market assumptions are the same. I work with BlackRock, with ASU Foundation. They have $7.4 trillion. Their capital market assumptions are a little below average. My wife works with Cambridge Associates for the Flynn Foundation. Their capital market assumptions are low. So over the next 3 or 5 years, I think it's going to be tough to earn that 7.3%. If we had Paul Matson here, he would tell you, well, when's the average dollar going to be paid out of this fund? 28 years from now, 36 years from now. And he would say, who's going to be president 36 years from now? You have no idea. Might be a Republican or Democrat. Might be some other party. Who knows? And over the very long term, that's the beauty of the pension. It's a very, very long-term asset. So it allows us to take a long-term perspective. So the answer is over the next 3 or 5 years, it's going to be tough to earn that 7.3%. Over the next 25 or 30 or 35 years, there's no reason to believe we couldn't earn that. And we're going to have to, and the keys to doing that are to be careful about what we're doing, to make sure we have a good mix, to make sure we're well diversified, and work hard to get the expenses as low as we possibly can. And that's exactly what we're dedicated to doing.
Thank you.
Do we have any more questions?
I have one
Yeah.
question. How do we balance, because it seems to me like we've been chasing our tail for the last 10 years. How do we balance what the objectives are with the investment team, with you at the board? Because it just seems like, you know, we've lost a lot of opportunity over these last 10 years, and I sort of grade us to the Arizona State retirement, which has been cruising at 15% for the last 10 years. Are we ever going to get to that point? Are we going to ever have that true consistent return? Is the board ever going to say, hey, where is the stability?
I can't get back what happened
I know.
over the last 10 years. And we didn't have enough asset allocation to risk assets.
But that's what I'm saying.
Right.
We had no, it's like last year I listened to, we want to hear the word, we don't want to hear the word risk. Where risk should, I think, always be somewhere
I
in
started
that
with
investment
risk.
theory.
I started with risk, and we started with a proportion, the capital appreciation, and, you know, to make it clear, that's where the long-term growth is going to come from. And we have ratcheted up risk a fair bit. We try to do this opportunistically. I can tell you that in the fourth quarter of 2018, the market went down dramatically, about 15%. Why? Because of the recession in 2019. We looked at it and said there isn't going to be any recession. Stocks are on sale. And so Mark and his team added 3 or 4% to equities in the fourth quarter and early in the first quarter of 2019. That helped a lot. We have some more complex assets where we dialed up the risk a little bit, and that has helped. So I think so. The reform, the Proposition 124 and 125, took away the PBI problem.
I'm just saying, is the risk going to be, oh, next year we're not going to have any risk? Is the next year we're going to, it just seems like we up and downed it, you know, for the last 8 years, and it hasn't been consistent investment. I mean, 1% one year, 7%.
Markets are going to be volatile.
I understand that, but we've had a solid market for the last 10 years.
Right, and again, I can't get back what we didn't earn 8 years ago. What I can do is make sure the asset allocation is appropriate going forward based on the risk that we can take, based on our cash flows in and out of the system, and based on our best judgment about what market conditions are at this point. And from my perspective, we have an overall risk allocation, let's call it about 65%, that's about right. Right now, the market's right at an all-time high. So I don't think opportunistically this is a great time.
I agree.
Over the next year or two, if I could bump it up to 70% from 65% risk asset, in my mind, that'd be perfect. That's where I'd like to go, but I can't do it today because the markets are not opportunistically priced to take that step, in my view, and in the view of the team.
I think maybe if I could speak to that point a little
Sure.
bit. One of the things that I kind of tell people, explaining the difference between investing for a pension and investing for, you know, your typical consumer 401k, is that if Harry says, like, at the end of 2018, when markets tanked 15%, it really doesn't matter that much to me in my 401 because I'm not taking it out tomorrow. I'm taking it out, 20, 25 years down the road. For every year for a pension, we have June 30th, which is the end of the fiscal year, and that's like the clock striking midnight. And if we have a drop from June 20th to June 30th, similar like we had in December, and our final score comes in right at that time, and it's severely low from any sort of market turbulence like that, then we can inadvertently create real problems for few employers. Not a ton, but there's enough employers with very low funding levels and very high contribution rates. And I think our investment team has been terrified of accidentally turning off the lights on people if we lose money when that clock strikes midnight. So I think that's one of the key takeaways that I really had to kind of get my hands around when I got to PSPRS. If you want to talk to that.
We have very different funding levels among our employers, and we need to be thoughtful of everybody there, and that gets into the risk we can take. We also, though, have a 7-year smoothing. It's technical, but basically it will smooth out the ups and downs so that the impact of a large up year or a large down year will not be that significant towards the contribution levels. So we want, obviously, the highest return we can get, but we also want to try like mad to dampen variations in the contribution rates, because obviously all the employers, all the employees are sensitive to that, and so we're trying to do that. So I think, so here's a prediction. If you start today, look for 10 years, I think it's an even bet that we'll win, maybe a little on our side, against ASRS over the next 10 years. I think we're well positioned. We've moved a fair bit to the direction that most other pension plans have used. Just because everybody's doing it doesn't mean it's right. But if you're doing something wildly different, there's a good chance you are wrong. We've moved towards where most others are, and many of the asset classes that we've been heavily invested in are now being adopted by others. For example, private debt with ASRS. So I think we're well positioned. I think we've got a very strong investment team at this point, and I'd be happy to bet Paul Mattson that we beat him over the next 10 years on a total return basis.
Well, we're about 5 minutes over, but we want to keep going. We can keep going.
Sure.
We don't have a problem.
Yeah, fine.
So, from a local perspective, the questions we get are from members, board members. We talked a little about the advantages of being able to take that long-term approach, 30-plus years on the smoothing side. The issue we're running into is my city manager doesn't look at that. He looks at his annual budget and his funding ratio percentages. So, on that smoothing side, we get a couple of questions. One is, obviously, is it going to be there in 30 years? From a current member standpoint, the pressure that it puts on the city manager, saying in Crossroads, drastically changes negotiations from current pay rates, raises, employee benefits, everything that comes into play from the total picture. So I guess part of this from a communication standpoint, how are we getting this message back to maybe city management when we take the totality of the benefit package, not just the pension that could or could not be there in 30 years, but the current employee benefits that's also impacting a 22-year-old firefighter who's not looking at 30 years, he's looking at, I need to get a COLA, my paycheck's $900 a month. So how is that communication getting down to that level where we can answer those questions?
We're trying, and I think we're stuck with the performance that the system's been able to show the last 8 or 10 years, which frankly is very disappointing. And I think the message, I want to send a message of hope in that what we're doing is very different. We've got different people, we're doing different things, it's more similar to the others, and it's well considered based on the evidence, the broad types of forecasts going forward, and we're trying to be very careful with that. So I'm hopeful that, again, things will be much better over the long term. The problem is, though, that we're at a fairly high market level. So it's unreal. My clients earned 30% in their stocks last year. That's great. They hope we do better this year. I hope we do too. I wouldn't hold my breath. Things are relatively high. But there's a balance, and we've got each employer's got to have the right balance for their particular situation. Yeah.
Generally, Treasury is regarded as being safe and profitable. I'm looking at that breakdown and I'm wondering why or what led to the decision to diversify in such a way that you have the same ratio of debt, private credit, and U.S. equity? And when we look at the return on the private credit compared to U.S. equity is return far outweighs the credit. What led to that decision? I'm just curious.
So stocks are very volatile. When they go up a lot. When they go down a lot. The debt doesn't have anywhere near the same kind of volatility. And the private debt, it's risky. There's credit risk with it. There's business cyclicality risk to it. But the likely return is 8 or 9 or 10%. The treasuries, which we have very little of, we know what those are going to return. They're safe, but they're going to return 1.5 or 2%. And with a 7.3% target, every time I put an asset in a 2% return and agree to get that, then all of a sudden I've got to get 14%. If I put $1 in a 2% treasury, I got to put $1 in something where I feel really confident I'm going to get 14 or 15%. And that's hard today. So we have a little bit in the treasuries for liquidity and the high quality bonds for liquidity, but because the yields are so low today, we don't have very much there. And the returns, the private credit, so these returns in this column are going to vary a lot quarter to quarter, year to year. We look more at 3, 5, 10-year kind of returns, and we do have a slide with that. But
It's becoming really small.
I don't think
This is
people
on
will be able to read
this
it.
is on our website. And this report comes out to our board of trustees every month.
So what is the annualized return on a private credit?
I'm going to say historically close to 10% over most time periods. Now, going forward, I don't think it'll be that good. I think it'll be more like 7 or 8%. But that's still pretty good. Yes?
So you said that over a long term, like 30 years, you think will be like around 7.3% or whatever.
Yes.
With a closed amortization period on the unfunded liability of 17 years, is that a long enough period that you think it's going to be around that? What's your prediction?
That is a stressor for us. The period is different than when the average dollar comes out of the fund. But there are some actuarial issues that can cause more substantial swings in contribution rates than you'd be comfortable with or I'd be comfortable with. And we're going to deal over time. We have new actuaries. You'll have a chance to see them this afternoon. They speak English, which is really good. People joke about actuaries as people that don't have the personality to be an accountant. But these people are pretty good. They're very knowledgeable about what they're doing, and we're working on that. But it is an issue. Other questions? Well, we thank you, and you're involved.